of, this could have been my life is he gets a chance to kind of go back to his investment bank life. And as he gets positioned back to do that again, he asks his wife, in this movie, Leah Tione, his wife Kate, he takes her to the city, to New York City, and it's got this big suite, right? And he says, "Hey, this is where we're going to live now." And he says, and she looks at him with this look like, "Well, I got to take, our daughter out of school," and she just goes through all the aspects of what she loves about her life as suburbia. But he's saying, "But yeah, we can have all this, and all this is great." And she just, at the end, she kind of goes, "Okay, Jack, whatever you want, whatever makes you happy, I'll do it." And he really gets a second chance to look back and say, what is this really all about? And I think it's really important to think about that, particularly this time of the year, because we're all drivers. I certainly have been. I still do have a tendency to do that, although a lot less than I used to when I was younger. But we get in this mode of, getting out of school and getting a chance to go out and make money in the real world. That's what we work so hard for, and to have a family and to create some stability and security and live a better life, because gosh darn it, we earned it, right? We put a lot out there on the table. We risk a lot. We put up with a lot, and we deserve it. And I'm not making a judgment about that at all. But what I'm saying is, in this movie, it really brings back the aspects of what is success, like redefining success. Is it all about how much money, how big a lifestyle, or is it about relationships, memories, connections with people? And that's what the movie's about. The concept of a second chance, redefining success, and life choices and their impact. And the reason why I give this to you is I'm going to give you a little bit of construct of some choices I made in my life. Not all good, not all exactly the way I would want them. But I'm also going to start with somebody else. And many of you may know who this is if you are on some of the Facebook groups and you're into some alternative investments. Dr. Roshan Kaira. Dr. Kaira is an Oklahoma City dentist. He graduated from dental school in 2017, moved to Oklahoma City because he saw an opportunity. He had no family there. He had nothing there other than an opportunity. He saw an opportunity to start a franchise dental practice there. And some 6 years later, he's, quote, retired. Now, he's certainly not retired from life. He is definitely a guy who had a lot of focus and clarity very early on, even before he graduated from dental school, as to what he wanted to do. And he's been very specific about it. And the reason I bring him up is because there's a lot of commonality between what Dr. Kaira is doing right now and what I did, even though I did what he's doing a little bit differently, but 35 years ago. And I'll give you my story in a minute. But I'm going to stay focused on Roshan, because he did what I did. He read a lot of books. He was very curious. Even though he knew he was going into dentistry, he was very curious about being a better investor and how could he create more freedom. And he said he really wanted the optionality to retire by age 35. Well, he did it by age 31. He's very focused. He did it faster than even his goals. Now, I don't want to take anything away from him at all, because there's nothing to take away from him. He did it during a time when he was largely single. I think Roshan got married about a year and a half ago, so he was single, no kids, at least yet. I think that's probably on the table for he and his wife. But he had a lot of time, and it takes a lot of time to put these things together. But when you're young and you got energy and you don't have all the obligations and all the entanglements, and entanglements aren't a bad thing, but they do take away from your ability to create freedom faster. He set on a course and really dug in and joined some groups and actually instead of just getting more information, he got out there and actually did something. He did something with it. And he is basically his post that he posted publicly before Christmas. He said, "I have replaced my dental income." And that's what I talk about a lot, is how do you replace your dental income? Not that you may want to. You may want to continue to practice and be in business for many more years, and that's awesome. You may think, well, I've ramped up my lifestyle to a certain level and it's going to take me a lot longer. Well, so be it. But in the end, getting more freedom and getting what we really want, not more money, but we want more time, getting that time freedom requires replacement income that's not dependent upon you doing all the work. Now, I still enjoy what I do, and I'll tell you more about that in a little bit. And Roshan has his sights on doing more in real estate. He still wants to be relevant in dentistry in some respect. He's not going to give that up completely, but he has the optionality to do what he wants to. And I think that's something I want to bring to you. 35 years apart, we've both done something very, very similar. I'm just a few years down the road and can kind of be your guide further down to show you that even through the ups and downs of the economy, through the volatility of the market cycles, of which I've gone through 6 of them, there's a way to navigate what we're going through right now. And it's not going to be the same as we've seen it before. The playbook, ladies and gentlemen, has changed completely. And that's not to scare you. That's not to make you think, oh my gosh, I'll never figure this out. No, you can, but you can't rely on what we thought was true in the past. A lot of the constructs aren't there. But let's move on. Who am I? Real briefly, I was a practice owner for about 20 years, so I did it longer than Roshan. I had a few setbacks along the way, so I stayed in it a little bit longer. But my whole goal was the same thing: is I wanted to at least have the optionality to have freedom earlier in my life, and not just go to that retirement age of in your 60s or your 70s, like so many dentists are having to do today, because they didn't have good financial acumen, they didn't have discipline, they didn't have a game plan to actually understand what they were trying to work towards. Real estate, like Roshan, enabled me to leave clinical dentistry in my early 40s when my daughter faced leukemia. She also had an outbreak of epileptic seizures and had a liver transplant by age 12. In the meantime, since I left clinical dentistry because of my daughter, I've had the blessing and privilege to help hundreds of other dentists and their families successfully create passive income to help them escape the chains. Even though they may still want to love doing what they do, they can do what they do on their own terms. And we've done it through alternative investments, which my expertise lies in real estate alternatives. You don't have to do everything in real estate. I don't even recommend most of you do everything in real estate. I just started very early, and I found that to be a place that, because of the relationships I've created over the years, my understanding of it and my understanding of the markets, that I'm very comfortable with it. But if you're just looking at it from the outside or just getting involved in it, you need to have diversification, no question about it. All this resulted in more time freedom for me and having options and peace of mind. And that's what we deliver to our many members who are part of Freedom Founders and have gone through and created their freedom in their life. So this is me back in 1983, graduating at age 26 from Baylor College of Dentistry in Dallas, Texas. I purchased my first investment property while I was still in dental school, my first year in 1980. As I said, I graduated in 83, and I sold my dental practice in 2005. After really having a real epiphany in terms of my daughter's health situation, and realizing that I couldn't continue to manage being a father and wanting to be with her, going through her struggles, and also managing a dental practice. And I had to make a decision. I'll give you a little bit more of that in a moment. Here's the first house that I purchased. Now, I purchased it with the help of a financier because I didn't have credit. In dental school, as a student, I didn't have the ability to go get a mortgage. I had no income, but I had time, like Roshan. I had time, and I was curious, and I'd studied, and I found a great house and had a financier bring the capital and the credit. I managed it. We split the profits on it at the end of 4 years when I graduated, and we each took away about $25,000 in capital gain profits. Not mega millions, not hundreds of thousands of dollars, but 25,000. But back in 1983, that was a lot of money to a young guy who was graduating dental school and heading out on his own, to have that kind of capital in my hands to go do something with. And I kind of had a game plan at that point. I knew what I was going to do with it. It's my daughter, Jenna. This is Jenna in 1992. She's age two and a half. This is Jenna a couple weeks later. This is actually after she was diagnosed with leukemia, and the swelling is due to the steroids that they're giving her to try to start fighting leukemia. This was a very, very difficult time in her life and my life and with her mother's life. Fast forward, our marriage didn't survive all of this, but we remained good friends and good co-parents throughout the years. This is Jenna a few years later at age 12, when she had her liver transplant because she was in end-stage liver failure. And this was the time when I really made the decision that I needed to escape the chair, at least for a time, because at that point, being with my daughter was more important than all the money I could make or the money I was making. And I had a reasonable portfolio of real estate that was producing income, because I paid quite a bit of it off over the years. And I had enough to sustain me at least for a while. And that was the main thing. I just needed to buy back some time for a period of time when I could be with her, because I didn't know if I'd get another chance. And I'm relating this back to the movie that I just talked about family man because I was also not an investment banker. I was a dentist like many of you, an entrepreneur, a business owner. But I also wanted to try to create a lot of wealth. That was my goal. I didn't know how much. I just know I wanted to create it. And real estate to me made a lot of sense. But I was also trying to split time in a lot of different places. And I just had to have this moment of time that I decided I could not keep doing all, and I decided I would take some time off and ride the assets that I had, which gave me that time back, and give some time to my daughter. So today I want to talk to you about your equity, your capital, your wealth. Is it at risk? And I would say that there's a lot of things at risk today. I'm going to give you some of those in a moment. Again, this is not to scare people, but I think we all have to be more aware of some of the issues that we're facing today. So here's some of the current risk factors. Are we going to have more inflation? Are we going to have deflation? Are we going to have a recession? We've had crazy, irresponsible monetary and fiscal policies over the last, well, going back to the Federal Reserve when it was created in 1913, to be clear, but particularly since COVID, and we can go back to the Great Financial Recession, 2008, the monetary and fiscal manipulation of the markets has been tremendous, and that is not going to end. There's just no way I see that ending until something breaks. We're in an election year. Well, that changes everything, does it not? So politicians and the Fed can talk one way, but when it comes down to an election year, everything's political. And so I think, again, we can't look at free markets anymore. We have to try to figure out as best we can what's going to happen and who's going to do what because of what. Nothing makes sense anymore from a true economic standpoint. It just doesn't. And we can get caught up in the tailwinds of a market that's been going up and up and up for a number of years. We've got to be really careful and not get caught up in that euphoria. Government control, more and more control over every aspect of our lives. We all feel it. You feel it. You see it. Central bank digital currency, possibly on the way. They want to control our lives every way they can. It's going to get tougher and tougher to maintain freedom and autonomy. And that's really what we work hard for. That's what we take risk for, to have that. How are we going to protect that? And more importantly, how do we help protect that for the future generations, our kids and grandkids? I mean, that's what I care about today. I think I'm going to be fine, but I worry about the younger generation who's getting saddled with all of the irresponsibility and all the debt that we're currently piling up as a nation. It's completely irresponsible. We have huge geopolitical risks right now. And this often happens, if you go back in history, when there's a lot of financial malfeasance. Virtually every country across the globe is in massive debt today. And that creates the risk and the tensions. And historically, that's where warfare breaks out. And we had Russia-Ukraine almost 2 years ago. And now we have the Middle East conflict. Who knows what else comes up? China is still there looking at Taiwan, for example. There's so many things that could break out, and those issues can change everything. All the dynamics of any prognostications can change overnight, and we've seen that happen before. BRICS, the countries that are tired of having the dollar weaponized against them, which a lot of very smart people said we should never do it, and we've done it. And so they want to pull back. They want to create a different currency, and it's happening. It's not going to happen fast, not going to happen tomorrow, not going to happen this next year, but we are in a position where in time we could lose the reserve currency of the globe. We've had it for almost 100 years. I think Bretton Woods was 1944. This won't last forever. These are danger signals, and again, it may not affect us today, tomorrow, but these are problems we have. We are no longer the strong creditor nation that we were some decades ago. We were one of the biggest debtor nations, and that's a national security risk, if not an economic risk. The overall asymmetric market risk. We've had tailwinds galore since 2008, and particularly in the last 3 years with COVID. You all know what happened, all the stimulus money. We had both monetary and fiscal stimulus at the same time, and that's just blown everything up. Everything's distorted, everything's disrupted. Everything that we might have thought was true in the past is going to be completely upside down. You got to grab what you can from the market, but if you think you're going to keep riding a higher and higher and higher of whatever you're in, that includes real estate, you're going to be badly mistaken. And then when's the next shoe going to drop? What's the next black swan event that could start the domino flow of things falling apart completely? Who knows? I'm not here to tell you. It's going to be some event, but it could be anything. It could be anything. It could be in this country. It could be externally. We don't know. one thing to realize is that we have had tailwinds, essentially tailwinds for the last 40 years. I'm taking a bigger swath at the economy. Going back when I started in 1980, the federal funds rate was up at 20%. And you can see by this graph, the height there is right at 1980. And interest rates started coming down over 40 years, down to next to zero in the summer of 2020. And now we're on the flip side back up. They will not go back to 20%, but that's not the point. We are going to be in a different dynamic where we're not going to go back to those low interest rates. There'll be more fluctuation, I think. There's going to be more inflation, I think, in the future, and that's going to require interest rates to go up and down more. We're not going to get back to those rates that we had where we had cheap money chasing too few goods, and that's what caused a lot of inflation in the first place and caused a lot of the bubbles in the financial markets, real estate markets. Wherever you look, we've had this extreme monetary and fiscal stimulus that's caused a lot of this. And if you've been in the game, you've got some chips you can take off the table. When you take those chips off the table and where you put them, that's probably the biggest consideration most people have today. We get a lot of people coming to us at Freedom Founders saying, hey, I'm getting ready to exit the practice. I'm going to sell to a DSO. I'm getting all this capital and I don't know what to do with it. I'm afraid to put it in the market. I can't just put it, in savings or T-bills. I've got to do something with it. I need to learn how to do it. And I think that's what it comes down to is we all have to be more dominant in terms of our ability to understand how we're going to invest our money outside of our practices, which is our primary engine. You've got to understand the full cycle. We always go through cycles. And I think we are right now, if you can see my cursor, we are right here where we had this little bit of a dip. And we're back. So 2022, we had this dip here. Now we're come back up again. And I think we're just getting ready for the capitulation. And when things start to drop, whatever that next shoe to drop is, there's going to be a massive correction in the equity markets. We're already seeing it in commercial real estate. The financial markets are still riding, they call it the Santa Claus high. The Fed pivot that happened, a week ago, no more looking at up to now, I think 7 interest rate cuts over the next year. I think it's all fantasy. But the markets are the markets, and the financial markets are based a lot on emotion. And that's what's scary about the financial markets. I'm not making a judgment. If you like to play there and you've got some trades going on, have at it. But I'm looking for more fundamentals. What's going to carry me across the finish line years and years down the road? I've got to understand what that looks like. You can play moonshots on the sidelines all day long, and that's fine. But you've got to have some fundamentals that are going to carry the weight for you. And I've done that successfully over 44 years in real estate. It can be done because it's a very fundamental investment that doesn't go out of sync. It's not a fad, is what I'm saying. We had Jay Powell, a year and a half ago, telling us not to worry. Inflation is going to be transitory, and it's been very sticky. Now, it's coming down, but I think that we're going to definitely have more inflation because why? Well, we have massive debt and deficit spending. And the only way for a government to ever deal with politically massive debt is through monetization of that debt, which is inflation. So inflation is not going to go away. There's going to be a back and forth tug of war with that, and interest rates in general are going to stay higher, even though they could drop them a little bit this year. But as soon as they do that, what's going to happen? Inflation is going to come roaring back again. They're going to have to raise them back up again. So you're going to see a lot of up and downs, I believe, like we haven't seen overall. Usually we have these cycles; they go up and they come down and correct, and they go up again. I think we're going to see a lot of up and down after we have a pretty strong correction sometime probably later this year. Some lessons from history. This is also interesting to take a look at. In the gray line, we're going back to the 60s and following the gray line where in the 70s, we had this massive spike of inflation. This is during the stagflation era of the 70s. And right here, Arthur Burns, who was the federal chairman back then, helped with interest rates going up, bring inflation down, but he took his foot off the pedal right here in about 76, 77, and inflation spiked back up big time. And Paul Volcker had to come in and crush it with also crushing recessions back to back in 1980 and 1981 by taking interest rates up to 20%. So here we are right now, inflation coming back down. Here's the high back in a year and a half ago, or June of 2022, I believe, where we were at about 9.1%. Now we're down to about 3%. And the Fed, Powell, is talking about interest rate cuts. Same thing Burns did back in the 70s. And look what happened there. So not saying it's going to absolutely repeat, but there's a good chance that we're going to see another spike, and that's going to change everything that's happening in the markets right now. So a Fed pivot. Powell was really talking hawkish for the last 8, 9, 10, 12 months, raising interest rates repeatedly since March of 2022. And a week ago, he comes out and goes, I think we're good. I think we're good. And starting to look at rate cuts. We'll see what happens. We'll see. But again, I think the financial markets could definitely see higher highs in the coming quarter. And if you're playing that game and you can take some chips off the table as you go, I think it's a smart move, right? I don't play there, but if you are, but again, if you take chips off the table, where are you going to put them? What are you going to do with them? Well, maybe you just go to cash or T-bills in the meantime, near term, that's fine. But long term, you're going to have to get back in the game somewhere. Where's that going to be? Essentially, Powell's between a rock and a hard place. He's got no room to move now because the debt this country's taken on is way more than it was a decade ago, and certainly back in the 70s when Arthur Burns and Paul Volcker were dealing with it. You can't raise interest rates anything close to what they did back then because this country can't afford it. This country's already broke. We are broke, and we can't do anymore. The Fed's just been printing money hand over fist, essentially, is what they've been doing. You can't solve a debt crisis with more debt. It just can't happen. It's just like giving more crack to an addict to solve the problem. It just never works. But that's what our government and what our politicians do. Why? Because they're just in for more power. They just want to retain power and make their profits and leave the problems to somebody else, which essentially is our kids and grandkids. That's where the problem's going to come. So with all these things that we don't know, they're going to happen. Because again, I'm making some general prognostications about more volatility. That's all I'm going to say. But Jeff Bezos often says, he says, don't tell me what you think is going to happen. Tell me what's not going to change. So let's think about that a little bit. Government control and power, more regulation, more wealth extraction and redistribution. That's not going to change. That's going to be there. So we've got to understand that's a given. Government irresponsibility, more debt and deficit spending. I think that's a given. That is not going to change. Human behavior, FOMO, euphoria, greed. It's just part of our psychology. We're all tempted to jump in on what everybody else is doing. We see all the social media. We see people making successes here and there. It's like, well, I got to get in on that. Well, I got to get on that. That's what drives the financial markets. One of the reasons I like the tangible hard asset markets, business, real estate, is because they're not driven by emotions and greed. They're more illiquid, more inefficient markets, and therefore it takes a lot of the sentiment out. Now, I'm not saying that there isn't behavioral aspects in those markets, but it's a lot more fragmented, and you don't have the high spikes. There's definitely trends, but not the high spikes that happen with a lot of volatility. We need more investing in fundamentals. Now, you can choose what you think are fundamentals. Some people might say it's precious metals, very fundamental, right? Gold, silver, very fundamental. Well, maybe some money in that would be good. Commodities, energy, housing, healthcare. To me, those are fundamentals that we're always going to have needs for. How might one invest in any of those? Well, that's what you've got to learn. You've got to decide what you want to invest in, and then learn everything you can about it, or make connections in those areas where you want to invest. But just don't follow the Pied Piper who's on the fad today, because those are the ones that usually turn down and cause a lot of heartache and a lot of losses. This is a little clip from Robert Kiyosaki's book, Rich Dad, Poor Dad, and it highlights, he says, most people simply buy investments rather than first investing and learning about investing. See, this is what I think is a fallacy in our culture. We learn everything we need to learn to become a professional or learn a trade, and we put a lot of time and effort into that, and we continue to do that. We're investing in ourselves in that regard, and that's smart. That's what we have to do. But what about making our money work for us? Where's the investment there? Most people, well, there's just no time. And Wall Street and the financial markets will tell you, you don't have time, you don't have the expertise, so just give your money to us, and we'll take care of it for you. And I think that is a strong abdication of responsibility. But if everybody else is doing it, then everybody says, well, then I should do it too. If you want to be different, if you want to be a Roshan or a David, you're going to have to take different steps. And there's different paths to do that. We'll talk a little bit about that, which path might be right for you. But I think this is whichever path you take, whether you're younger and have more time to go out and start learning. You should always be learning. You should always be curious, no matter where you are in the spectrum of your career in life. But where's your time best used today? That's going to be the key. And we'll differentiate a little bit of that in a minute. I'm not going to go deep on this at all. People read the articles I write, but I think the 401k is a scam. It was changed from a defined benefit program back in the 70s to a defined contribution, which put the emphasis on the worker to contribute to their own plan. and it's going to fail. Now, I don't mean it's going to fail because you can't, get tax deferral and build up some equity or capital. What I'm saying is, I say to people, why would you abdicate your money, your hard-earned money, and put in what I call a lockbox? Tax deferral, IRAs, 401ks, those are lockboxes. And you can't get your money back out again until you're 59 and a half. And while they're in those lockboxes, unless you learn how to self-direct, which is one thing we do in Freedom Founders, you can't do anything else with that money. I had a 401k once. I do have IRAs. I have a Roth. My daughters have a Roth. So I'm not saying you can't have them, but to put all your focus or the preponderance of your focus on those vehicles, I think is a big problem for most people. So you've got one, like doing it, fine. Most people that come to Freedom Founders and say, almost without exception, one of the first things they do early on is they end up terminating their 401k plans and push everybody's investment accounts into their own individual IRAs. So your staff doesn't lose anything. You can still compensate them on profit sharing plans that they can still invest in their IRAs. But the key thing is you get control of your money. So at least you don't have to keep it in the stock market unless you want to keep it there. You can actually invest it into alternatives like real estate and have more control over it, even though it's going to be in that lockbox till you're 59 and a half. The other thing I see with 401ks is we get a lot of younger people that are in their 30s and 40s, maybe even early 50s. And they've got a lot of money because they were disciplined and they put a lot of money into the 401k in their IRAs. Again, great, good discipline. But they like to check out and take some time off. Maybe even bring an associate in or a partner in or just breathe a little bit, and they can't because the money's in the lockbox. They have to wait till they're 59 and a half. Do you think there's a reason that Wall Street set that up with Congress back in the 70s? Yeah, because Wall Street wants to keep your money captive. So as long as you're good with that, then do those plans. But I'm just telling you, you can do without them. Roshan Kaira is 31 years old. He is not retiring off of a 401k or an IRA. I'll tell you that right now. Now, he may have them also, and there's nothing wrong with having them. But if you're relying on them to set you free, I think you're making a big mistake. So I'm gonna stop there on that. In Freedom Founders, we talk about your freedom number. Your freedom number, unlike what they teach in the financial markets or with your financial advisor or your money manager, we don't talk about, how many millions of dollars you need to have stacked up in your accounts. That's the accumulation number. We talk about a cash flow number. Why? Because we invest in assets that can produce repetitive, sustainable, predictable cash flow, and also has an inflation hedge to it. That's what real estate does. That's what business does for you. As long as you're in business, you have the inflation hedge. You've got a money machine. Now, the downside is you've got to be in it, working in it, but you can, over time, pull yourself even out of that. So you could have business or businesses and tangible assets like real estate as your primary drivers. And you can still have the around the periphery, you can have anything else you want. But I'm just saying, going forward to get real freedom in your life and have certainty to deal with the volatility of the markets, you're going to have something that's more fundamental than just putting your capital, in the financial markets. That's just what I've seen over the years. And I talked to hundreds of dentists, and many have worked really hard, but they always wonder, why don't I have more in these retirement accounts? Why don't I have more? Because those accounts never really build up a lot. They go up and they come down. They go up, they come down. And the resulting over a period of time is very nominal. Whereas the real estate that I built up at the time that I sold my practice back in 2005, I had equity about 4 times what I sold my practice for, 4 times. And yet I probably put 20% of the time into the real estate that I put 80% of my time in the practice because I had to be there. I was the doer. I was the driver. I was the senior doc in my practice. So I had to be there. And it produced the income. But the equity that I made on my plan B in real estate was 4 times what my practice did over those years. That's significant. That's what Roshan's already figured out in his 6 years. Now, he had the tailwinds of low interest rates and cheap money, but I'm not taking anything away from him. Again, he had to go do it. And this is what we find in Freedom Founders that sets people free, is they get the certainty of knowing their assets are actually producing something real and viable, and also have that inflation hedge to them. I like this meme. Imagine playing Monopoly and never buying any assets or investments that generate income. Imagine you just went around collecting $200, giving your money to the rich and trying to stay out of jail. That is how most people live their life. Now, you're not necessarily doing that, but when you're going around the board and giving your $200, you're giving it to Wall Street. Most of you. That's where you're putting most of your money. And in your practice, which is good. Your practice is that tangible asset you can make something out of. But again, someday you want to take your foot off the pedal of that practice. and slow down or transition out. And then you've got to figure out, now what do I do with that equity? How do I make that equity work for me? That's what I see in most docs that are trying to transition exit today. They want to do it. They've got an LOI, they've got an offer on the table, and now they're saying, what do I do now to make this equity work for me to keep up with the cost of living that's going crazy in the last 3 years, and it's not going to abate anytime soon. All right, a couple questions that come up that none of you will probably ask because you're too polite, but I'm gonna go ahead and hit them. People often ask me, David, why do you do this? If you're so free and life was so good and you figured all this out and got to escape your practice back in 2005, why do you do this? It's because I love what I do. There's another, I think, a quote by Mark Twain who says, if you love what you do, you'll never work another day in your life. And there's no way I could not be relevant somewhere, somehow. I think Roshan Kaira is going to do the same thing. He may still do some dentistry here or there, but he's not going to sit back and it's not going to be all about him. He already serves a lot of young people and young dentists in his group. Service is a great thing. Also, I care about the future generations. As I said earlier, I'm likely going to be okay, but I care about my daughter. I care about my grandkids. I care about this country. And if we don't do something to help the young people, like in Freedom Founders, we have a next gen group where we invite the adult kids of our members to come to our meetings so that they can experience a different mindset and see that there's different avenues to get to their freedom point than just going down the constructs that have been laid before them, which is higher education, get trained, go get a job or get a career. And what they see today is too much debt and not the ability to do what many of us had the opportunity to do back in the years when we didn't have things so out of whack in the financial markets. It's a lot tougher today. You all know it. If you're younger, you understand what I'm saying. If you're older, but you've got kids or grandkids, you know exactly what I'm talking about. It's not going to be easy. And just giving our kids or grandkids money is not the way to do it. Certainly, we want to help set them up, but we want to make them resourceful and resilient and give them the tools that they're going to need, because the tools of understanding what you're doing is going to be more important than just having money. In fact, having money is probably the worst thing you can do to people. So that's why I do this. I love it. And I've got a great team and we've got great members, and I get to work with great resource partners in bringing the investments that we curate and vet at a high level basis. So it allows me to do what I want to do, but I get to give the benefit of the leverage to hundreds of other people who want to do it with a community and do it together, where you have that leverage and you've got other people that are alongside you and you get to ask questions and people that are of your caliber. And it's just, I love being part of communities and masterminds. I've been a part of them for many, many years. And while Freedom Founders is mine and what I created over the years, I'm a part of other groups too, because why? I want to be in places where people make me think and they challenge me. I always want to learn. I've always been a learner since my days in school when I was splitting time between anatomy and physiology and biochem and reading books on real estate. I mean, that's how I split my time. I've always been that way. And many of you are the same. You're just trying to figure out, how do you do it? How can you split time also, because you're very, very busy in everything you do. So that's why I do this. That's why I quote still work. I really don't work. I just enjoy the heck out of what I do. It's just fun, and I get to spend time with people I love to spend time with. There's nothing better. And I want you to have the same thing in your life sooner, not later, not at retirement age. I want you to get to have that even while you're still in practice, to take the pressure off and have peace of mind that you're going to have enough. It's not this big number you have to pile up, but you're going to have enough. But you've just got to understand getting investments in fundamentals that you can understand and produce reproducible income is what's going to give you that peace of mind to say, hey, I'm going to be okay. The other question is that, all right, David, well, then why don't you just do it for free? Well, I know that when I don't invest something, put some skin in something, if it's free, like an online course that someone says, likely I'm not going to put much effort into it. When I have to invest something, either my time and or some capital in something that I think is going to be good, then it means I usually put some time and effort into it, and therefore I get results. And so I don't give much of anything away for free. I do give a lot to the Next Gen group. I give a lot in charity to people who really need it. But to my fellow colleagues, I want to set a bar that's relatively high, and I want to have a caliber of people who are dedicated to the cause. I don't want tire kickers or people who just want to give something away for free. If you want something for free, you can read books and go to podcasts. That's all free, and I do lots of that. So that's where I give my stuff away for free. But what I want to do is work with people where I am not more invested in their future than they are, if that makes sense. So that's my answer to those questions that come up quite often. Okay, a little bit about the Freedom Founders community. This is not to sell you on Freedom Founders. I just want to make you think tonight. But a little bit about, because some of you want to know, we do provide access to carefully vetted real estate deal flow. That's leveraging the community. We have a proven system to create recurring cash flow for our members. We create a blueprint, a real game plan to create that passive investment model without people having to be active. Now, again, nothing against being active. That's what Roshan does. That's what I did when I was younger. Our members are usually further down in their career. They don't want to go and be landlords and deal with contractors and tenants and fix and flip houses. We lend money to people like that, but we're not in that game. And so we have models that allow us to do that and be semi-active, certainly active in orchestrating our money, but not active with our hands in the actual model. We are a community, and community is the key. We're like-minded. We're dentists and healthcare professionals, and we use real estate to create more choices, to buy back our time and create that financial security, which is really what we want, because that's what gives us our time back, is knowing that we're okay, that we've got a good fundamental investment in front of us. The main problem we help practice professionals solve is helping them buy back their time, get their time back by confidently replacing their reliance on active income from their practice. So when they can see their assets are producing a certain run rate of capital, even if they haven't hit their freedom number, it starts to relieve the pressure, because they can take more time off. They can take a longer weekend. They can take a longer trip with their family. They can maybe go into the practice later in the morning and take their kids to school, or take off earlier in the afternoon and go coach soccer or Little League or whatever it is, without feeling like, oh, I have to be in the practice because if I'm not there, I'm not cranking out the money. It changes everything. And again, goes back to the movie, The Family Man. Where are we putting our emphasis and priorities? It's a tough balancing act, but once you understand the investment fundamentals and creating that passive income, then that changes everything for you. Historically, people know that real estate is one of the best ways to create passive income. It just is. Most high net worth investors believe that real estate should have a place in their portfolio. The question always is, how am I going to do that? Many become what I call accidental landlords. They had a house, they moved, decided to keep the house and turn it into a rental. Okay, how'd that work out? Most people, it's a wrong move, and trial by error, they find out that wasn't so much fun. Or they got in the short-term rental craze. Because everybody's making money hand over fist in short-term rentals. It was the fad. That's all tumbling down now, and they over-leverage themselves, or just don't understand that operationally, real estate requires really being a business of its own. Operationally, it's what it requires. And Roshan Kaira would tell you that. He's built out a business to allow him to do what he does with his time in finding more deals. But it does take time. And it's not something that you can do accidentally or as a hobby. Freedom Founders is like a shortcut that enables professional practice owners to full-time become more sophisticated investors while they're still busy in their practice, or while they're in the mode of exiting their practice. I'm starting a group, small online group. I've done this for several years on a 4-week sprint. It's an online group. It's a master class in creating passive income with real estate. Small group style, lots of interaction. It's engaging. I keep the group small enough where we actually are talking. I'm not doing like tonight where I've got so many people on a webinar that I couldn't have interaction here with all 70 of you, because there'd be too much. But in a small group, we can interact and I can answer questions. We do case studies, feedback on situations you have. You bring provocations about anything about your investing, your capital, your commercial real estate, your IRAs, your 401ks, paying off debt, not paying off debt. Should you get loans right now? It's just, we cover all that. 1031s in exchanges. Where do you do that? How do you do that? All the questions that you have about navigating your particular situation. It's designed for busy people. I condense things down to give you what you need in a short period of time. I also bring some of our veteran members, our Freedom Founders, so that you can have interaction with them as well. They'll give you a lot of their insights into how they came to Freedom Founders, what they were thinking, what they were looking for, and what they have found. And I think that's inspirational to hear other people who actually gone down a path that others have gone down, the path that I basically lead people, which is my own path. This is all virtual. You have no travel at all, so it's easy. It's online. This group's for you if you're a practitioner who distrusts the Wall Street model or just wants to diversify and get some chips out of that model into something that, in my opinion, my experience is more fundamentally sound. You understand the value of real estate, but you are not sure how to get started, because right now would be a dicey time to get started. 4 or 5 years ago could have been a good time. Like Roshan got started in 2017, ideal time, ideal time. Right now, you got to really know what you're doing. You may have concern about potential market correction recession. I certainly do. I would be navigating to some higher ground right now if I were still in the markets and had taken some of these great gains that have come about in the last year. If you're a full-time practitioner like I was who lacks time for a second career in real estate, again, you don't have the capacity to go do a second career like Roshan has done very well. You want to invest according to the fundamentals and principles. You're not a trader. You don't want to speculate. That's not what we do here. It's not speculation at all. This is long-term, long-game investing. A couple of the previous people who have been a part of this group have said, trying to move my screen here a little bit. I'm an orthodontist and a previous student with David Phelps. Loved it. I'm trying to learn as much as I can to prepare and plan for my exit. Joining Freedom Founders is one of my major goals as soon as it's the right time. So this is a person who's not ready to be a part of the Freedom Founders community, but wanted to get their sights and their game plan and focus on how to move forward from where they are today to get there sooner, to be in a position where they could be a part of the group and invest capital that right now they probably don't have. Next one, Dr. Peter Erling says, thank you so much for the time and talent you shared with us, all of us during the course. I appreciate your time and the valuable things I learned. It set me on a path I look forward to following. And Dr. Steve Bacalar said, I'm skeptical by nature. I thought this might be just a pitch for Freedom Founders, which it is not. Pleasantly, it wasn't. He says you gave us a lot of fundamentals. I really enjoyed the structure and I appreciate the content. You really simplify things. That's my goal, to simplify. Complexity does not have a place in your investing model. If it's too complicated, people make it too complicated, probably not the thing you want to be in. So this is the blueprint days that we do for our members in Freedom Founders. Now, we do these live in Dallas. So this Catalyst group is going to be similar to the blueprint days, although we're not going to do it live. There's no travel involved. You don't have to join the community. It's a very nominal investment, and I make it risk-free. If you decide you'd like to join this Catalyst group that starts January 9th, runs for 4 weeks, you jump in for a week, 2 weeks, and you go, you know what? It's not exactly right, or it's not the right time for me, or I can't do anything with it. No problem. Just refund you. Not a problem at all. Mark Twain says, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And this is what I try to help people with is try to give them the insights and experiences that I've had over 4 decades. Now, the best thing that you can do to get more clarity and more focus on your situation is just schedule a discovery call. This is not a sales call. It's a discovery call. It's a guidance call to help you assess where you are, what you have going for you. There's a little bit of a survey to take, so we have a little bit of information about where you are. Perhaps the Catalyst group would be a good group for you. Perhaps it's not. That's what we can help you with on the discovery call. Perhaps you've been looking at Freedom Founders for some time. Perhaps membership in Freedom Founders would be a good thing for you. That's what the discovery call is for. Now, the only scary part about the discovery call is you've got to go through either Alex or Nathan. That's Alex, all right? Now, he's really a soft teddy bear. I mean, he looks tough, but he's a soft teddy bear. Actually, that's Alex on the left, and that's Nathaniel on the right. Those are 2 guys who've been with me 7 years now, who understand the model very, very well and take discovery calls, probably do 100+ each every year. They are very knowledgeable about what we do, can answer your questions and give you guidance. It's a free, no strings attached. I would just suggest if you're looking to try to figure out where you're going, what you're doing, this would be a good chance for you to do that. Basically, there's 3 types of investors. The first type is they have a plan and they don't need any help. They're good, feeling good, and are on the right track. The second type has no real plan, but they want to figure it out for themselves, and that's fine too. I was that way early in life. I wanted to figure everything out for myself until I found out there was faster ways to get things done if I would just combine efforts with people who already been there. And there's their third type, no certain plan at this point, but would like guidance and some collapsing of time. So there's 2 paths you could take. Well, it's actually 3. Let's get the first one out of the way. You do nothing at all. Nothing at all, nothing at all. You don't change anything, and you just let the markets and the dynamics going forward and the risks, play havoc with you. The other 2 paths would be 1, the Roshan Kaira path. That's if you have more time, less capital. You certainly can get with groups, and Roshan would be a great person to help younger people who want to get in and do it themselves. It's what I did for my first 10 plus years. I did a lot of it myself. I wasn't part of a group. I didn't invest in syndications. I didn't have the capital. I had to build up the capital. So if that's where you are, perfect place to go. Or you can do the David Phelps Freedom Founders Path, where if you want to collapse time, you've got assets and capital that right now that you'd like to figure out how to navigate better. That's what we do. So 2 pathways, both would work depending upon where you are. So my advice is schedule your call. You can do that like right after we get off of this call tonight, which I'm going to stay on and answer some questions for you. But I would suggest you do it soon, because the new year is a great time to really reset your focus in life and really reset and have those conversations maybe you haven't had with your spouse and your family about what they really want. Going back to the movie, The Family Man. Watch that movie the next few days if you haven't. Watch it with your better half and just have those conversations about the gratitude you have for life, but maybe some of the things that are missing, some of the things that maybe you are even regretting right now as we look back and you think about maybe people or connections that have been lost. Some maybe you can reconnect with because they're not gone. Other people, unfortunately, leave us, and we don't have a chance to go back and make those memories, at least anymore. As we all get older in life, we start to reprioritize what we believe is important. And certainly making money and being responsible financially, supporting our families is a huge part of that, no question. But figuring out how we can have any kind of balance, if there's such thing as a balance, and is really understanding how to invest your capital going forward. And I think that's something that if you're here on this call tonight, that's what you're figuring out. Maybe you figured it out, but hopefully I shared some things with you that would help. All right, I'm gonna stop my share screen, and I'm happy to take questions. If anybody has some, I'll stay on and answer questions for you. Let's see if you got anything in the chat. Cost of the Catalyst Group. Yes, it's $3,000. $3,000, and let me give you a little bit more of how it works. The week before we start, so we start on January 9th. I believe that's a Monday. I believe it's a Monday. Sorry, it's a Monday or Tuesday. I can look at my calendar. You can look at your calendar. But the week before, I will have created some pre-recorded training modules on certain concepts that I want to discuss on our live call on January 9th. That's our first call, because I want to have engagement. So you can watch my recorded calls. We'll have a Facebook community where all the calls will be put there, and you can watch those on your own time. That way I don't have to steal more of your time. You don't need to have me show up and spend an hour and a half, just talking through things when I can talk through and give those to you when you can be at the gym, or you can be walking your dog, or just whenever. But the live calls where we're going to have give and take. You'll all be on the screen with me. I'll see all your faces. You'll see mine together, and we're going to have discussions. And in the Facebook community group, each week, you put additional questions you have, and I'll either answer them on the fly right there. I'll either create videos to add some more frameworks to the question, and then we'll do a deeper dive on the call on whatever night that is, January 9th. Again, sorry, I'm just not going to look at my calendar right now. So each week, that's the way it'll happen. So each week, you'll get new modules to view on your own time that you'll bring additional trainings and things I want to talk about. But during the week, you can ask anything you want to. And as you ask questions, because it's an engaging group, then I'll create more training. I want this to be for you, customized for you. Yes, I have general frameworks I want to bring to you, but I want your questions to be the catalyst for what this catalyst group is going to do, because I love to have the engagement. I love to make it this way. So we'll do this for 4 weeks, all the way through to the end of the month. So hope that helps with that a little bit. Question, what specifically do you recommend for diversification of assets? The majority of our assets are already invested in real estate, both income producing and non-income producing, in growth mode, appreciating. So, it sounds like you're in equities, which is traditionally where we get our growth, where we want to be, whether we're in financial markets or we're in real estate. And the growth aspect has been tremendous the last 4 or 5 years, but even going back, coming out of the great financial recession crisis of 2008, we've had this big uptick, right? So everybody's been in growth, right? And everybody, if you've done things even nominally right, you've seen appreciation, you've seen growth. And along with that growth, income to some degree goes up, although you may have some capital that's still in growth mode and not producing the income. Same thing I tell people that are in the financial markets, Joanne. There's times where you got to take some chips off the table because we're going to have some rollover, meaning correction in the markets. I truly believe that's coming, even though it's been pushed back a lot further. You know the reason why it's been pushed back? Because we have all this fiscal spending. The Fed has been raising interest rates, saying we're going to crack down, we're going to cause a maybe cause some pain and some heartache and cause a recession. So far, they're going, well, I don't think we're going to have a recession. It's going to be a soft landing. No, we have had massive fiscal spending. You have monetary, Federal Reserve deals with that. You have fiscal, that's Congress and the administration. And they're pumping so much fiscal money into the marketplace. They're overriding the interest rate hikes to a degree, This can't go on forever. But just in this last fall, in I believe it was October and November, this past October, November, we, the country, increased the deficit by $383 billion. That's almost $400 billion, $200 billion a month. Let's see, 12 months in a year, that's about $2 trillion a year. We're adding to the already $34 trillion debt. So, sorry, I got on a tangent there. What I'm saying to you is that's why we haven't had a recession. So going back to Joanne's question, it's time to look at your equities and figure out which ones may be most susceptible to the rollover. Now, some equities, depending on what they are, and I'm talking about real estate now, I'm not talking about financial because I don't deal in that. Some real estate equities may be giving you good income and you've got good tenants and you're in a market where even if the prices, the values go down some, you feel like the economy and the people that are renting from you are strong enough that you can sustain that. And you might want to just hang on to those. But that may be a segment of your portfolio. So it's about allocations. It's not all or none. Some of your capital or your equity, you may say, you know, it's done really well. But I fear that particular asset or that allocation there may be a little bit more suspect to some of the things we may see coming this year. I might want to take that capital and put it somewhere else. Where we've gone a lot in Freedom Founders is we've gone to private credit. So we have equity, which is where everybody loves to be when the markets are going up, but credit, which is like being the bank, private credit, we can get yields on private credit today that mask equity returns. And that's not usual, except we're in a very unusual time right now. So it's safer because we're the bank, we get paid first. Now, we don't get growth out of being private credit, but I don't think we're gonna have a lot more growth. I think the growth is topped, in real estate particularly, the growth is topped out. Financial markets, I think probably have a few more highs to hit this quarter, and then I think we'll see them start to roll over. So Joanne, it's just back to allocations and really looking at your allocations on a spreadsheet and handpicking those that you feel like are strong enough, you can carry through. And I did that going back to the last 2008 crisis. I had a lot of real estate equities and they were fine. Even though their values probably went down 15, 20%, I didn't have to sell because, well, I wasn't over leveraged and I had good tenants and we just kept on going. I didn't raise rents, but I didn't have to lower rents, kept going. Now we've had a great increase since 2012, 13, 14, 15, 16, 17, 18. I started harvesting equity even the last 6 years, probably prematurely, right? But I don't like to be late. I like to be early. So I started harvesting equity and I've put a lot of it into private credit. I've put some into to energy, some other asset classes. I've got some of it in treasuries, all right? Because I want some liquidity. So reallocating, I think, is an important thing for everybody to do, no matter where you've been in the past. It's really time to really be dogmatic about where you are now. And we talk about a lot of that. We'll do that in the Catalyst group for sure. These are discussions I love to have. You can see I can go on and on about this, but I've got to take some of the questions. So I appreciate that one very much. Let's see. Jay, in light of the current economic and political environment, what percentage of your portfolio is in cash? Yeah, that's all the questions for now. Okay, great. So today, yeah, I'm probably sitting in about 25-ish, probably about a quarter my assets, and that's way high for me. That's way high. But I started moving that direction probably 18 months ago, little by little by little. And as I've taken some chips off the table and some assets, some I reallocate to private credit, some I've gotten some other assets, but a chunk of it's just gone into treasuries. Yeah, I'm getting 5.25, 5.5. It's I don't think it's even keeping up with inflation right now, but that's okay. I want the liquidity because I know when the assets go on sale, then I want to be prepared to go and grab those, and I'll more than make up for any loss in the purchasing power of those cash equivalents when I can pick up those equities again. This is the normal market cycle, and we're just waiting for. I've been waiting for it longer. I thought it would happen in 2023, but I just told you why it didn't, because the government and Congress are still just spending like fools with the Inflation Reduction Act. And of course, the stimulus money that came out during COVID, there's so much money that was thrust in the economy. It's I hate to use the word over and over again, but it was unprecedented. And so everything that even top level economists thought they could predict, they can't predict right now. You see people on both sides of the pendulum. Some are saying, oh, it's going to be bleak and we're going to have the worst back to the Great Depression of the 30s, and other people say, oh no, it's to the moon, to the moon. And you've got smart people. These aren't idiots, smart people that have a lot of experience, and they're saying things on opposite ends of the spectrum. That, my friends, is a scary time. And that's where I think diversification and hedging is what we've got to do. I could go a lot deeper on that, but I think that gives you a little bit of an outlay on kind of my thoughts in that regard. So I appreciate the questions. I appreciate your attention tonight. I kept it under an hour, which I try to do to protect your time. But I'd love to have as many of you that want to jump into the Catalyst group. We're about half full right now, so there's room for a few more there. But just have a discovery call with Alex or Nathaniel if you've got any questions about what we do here and if we might be relevant to you. Always happy to have those discussions. Alex, unless there's anything else, I think we'll call it a night tonight. Did I leave anything out?
I don't think so, David. I think that was great.
Okay, well, thank you all. Have a great rest of the week, and Happy New Year. Make it a great year. But remember, you've got to keep staying curious and invest in yourself the whole way through. Not a time to become complacent, and I don't think you will. All right, take care, everybody.